NIO reported its Q1 2025 results this week with positive top-line growth, but overall bottom-line losses. NIO remains to test investors' patience as it struggles to control costs in a hyper-competitive EV market. For Q1, vehicle deliveries surged over 40% year-over-year to 42,094 units, lifted by momentum from its upgraded product lineup and new entrants like the Firefly brand. Total revenue rose to 1.66 billion, up 21.5% year-over-year, and gross margin improved to 7.6%, a modest lift driven mainly by parts and service revenue. But while sales are up for the quarter and for the year, the bottom line shows NIO continues to struggle towards profitability, posting an overall net loss of 930 million, which is an increase of 30% from 1 year ago. And this seems to be a recurring theme for NIO. When you look at the previous 10 quarters, there is a persistent pattern. Total revenue increasing each quarter, but with a similar increase in costs. The financial data does show a clear pattern for investors to consider. Each quarter sees higher revenue bars, but paired with persistent red net income bars. Total operating costs, specifically R&D and SG&A, continue to weigh down NIO's profitability goals. Despite NIO management's cost control efforts, total operational losses increased again during Q1. Essentially, based on the numbers, the more NIO grows its top-line income, the more money it needs to support the growth. Currently, NIO's business model is stuck in a very common phase, where the company have not yet scaled production to a point where it produces vehicles with a profit margin that is high enough to impact the bottom line. Having said this, many companies overcome these margin challenges as they scale operations and improve overall production efficiency. I've no doubt NIO management is busy working on these business critical factors as it maintains its profitability target of Q4 2025. And NIO is going well in terms of top-line sales. April and May combined deliveries reached nearly 47,000, with Q2 guidance forecasting up to 75,000 vehicles being shipped. In relation to cost control, CFO Stanley Yu said in the recent Q1 earnings report, "Since the first quarter, we have implemented a range of cost control measures, including organizational restructuring, improvements across the supply chain, R&D, sales, and service operations." He also added that NIO aims to achieve structural cost improvements starting in the second quarter. I think we have heard similar comments like this before, so NIO really needs to start delivering on its promises and begin to show significant reduction in operating costs. I'm sure big reductions in costs will see a shift in investor sentiment as they start to see a path towards profitability becoming more realistic. For 2025 profitability, the company will need an increase in its sales volume, improve vertical integration, and continue to make a progressive shift towards the use of its in-house smart driving chips. But until these factors come to fruition and start pushing the numbers in the right direction, NIO will remain a growth story that frustrates loyal investors. Until costs come down, I don't see a recovery in the share price anytime soon. Based on the 1-year price targets offered by 24 analysts, average target price for NIO is $5.87, with a high estimate of $12.48 and a low estimate of $3.50. So this average price target implies an upside of around 75% from the current price of around $3.30. Not a bad return, but buying the stock now is high risk as there is still a long-term downtrend in place. Currently, we just don't know where the bottom is for NIO. It may stop falling and find support at $3 and then move back up to $4. It may remain stuck in this sideways $3 to $4 until there's a catalyst for a breakout. Or if investors run out of patience and there is a sustained sell-off, we may see the share price fall further based on weak investor sentiment and poor financial reporting. Thanks for watching.